In regards to oil, and you're referring to the petrodollar, is there a point at which the U.S. military machine gets called in to just say, hey, look, that's been such a great advantage for us, we really want to stop the competition or curtail it?
Well, I think it depends how smart they are. And so it's funny because, we did that in the past. Basically, some have argued that some of our military inventions were based on, basically maintaining the system. But when you have a nuclear power like Russia selling oil outside of the dollar-based system, there's little you can do about that militarily. They've been doing sanctions and things like that, for kind of related reasons, not necessarily citing that reason. Just, basically, we're unlikely to do, say, kinetic military action against that sort of, situation. Now, if they are smart, they basically would realize that the way that it's currently structured is that the United States military is doing a really good job of making sure that China is able to access all the oil they want. And so basically, it's one of those things where the cost has gone up and up and over time, whereas who's benefiting the most from the system is actually shifted away from the United States. And so right now, it's basically, we are paying for the system, but it's not necessarily benefiting us in the same way that it did decades ago. For most of this decade, we're going to look back and see that this was a rather inflationary decade. Maybe not every year was inflationary, but overall it was more inflationary than the 2010s, and that interest rates spent most of their time below the inflation rate. So if you were holding cash in a bank, if you were holding treasuries, you're probably going to get devalued over the course of this decade, maybe not in a straight line, but that those will, in hindsight, not have been very good investments. So a lot of it comes down to the fiscal situation, the biggest inspiration for me was Ray Dalio, because he popularized the idea of the long-term debt cycle, which is basically that you go through these periods of, the normal 5 to 10 year business cycle where the market increases debt in the system. Some of it's productive, but then towards the tail end of it, it starts to become unproductive and speculative. Eventually, there's some sort of catalyst that results in a deleveraging, and so you reduce debt, you go into recession. But then policymakers come in, they cut interest rates, they do fiscal stimulus, and they kind of short circuit that deleveraging cycle. And so by the end of that cycle, when it starts to, kind of go into the next positive cycle, you have a higher level of debt to GDP than the prior time, and interest rates are hit a lower high and a lower low than the previous time. And so when you string a bunch of those short-term business cycles together over multiple decades, you get higher and higher debt as a percentage of GDP, and you get lower and lower interest rates. And so what the long-term debt cycle kind of focuses on is after a long enough timeline, eventually interest rates hit zero or even slightly below zero in some cases, while debt is extraordinarily high, and that train has run its course. And so policymakers switch to other types of policies that can start with creating new bank reserves to buy assets, or then you can combine it with much larger fiscal stimulus than normal. So you put a lot of money into the economy, and so eventually what you do is you devalue the currency, which basically reduces the debt load as a percentage of GDP, because you boost nominal GDP through inflation and growth while holding rates below the inflation rate. And so, that's how they got out of the 30s and 40s trap, essentially. And so we're kind of going through the same cycle now. But of course, if you're a bond holder or a cash holder, you do very poorly in those types of decades. So I do think that fiat currencies are not very attractive in this current environment. So Ray Dalio, for example, referred to cash as trash, and I think that's it's a colorful way of saying that basically you're getting little to no interest rates, in some cases negative interest rates, to hold cash, and yet the inflation rate is in most countries positive, in some cases strongly positive, and so you're not keeping up with the rise in prices. And so if you're holding cash in a bank, probably 5 years from now, you're going to have notably less purchasing power. Even if there's no major inflation spike or major kind of reset or something like that, just the sheer kind of losing points every year is a big issue. And that's actually already been happening over the past decade, where most of the past decade you did not get positive real yields by holding either T-bills or cash in a bank. And it's kind of accelerating here in the 2020s. And so I do think that overall, fiat currencies are not a good store of value, especially in this current environment. And where capital is better treated, I think that it depends on what country you're in and what you're mainly interested in investing in. But I think that there are a variety of equities in the commodity space or in some of the value sectors that are pretty attractive at the current time. I think there are assets like precious metals or farmland that are attractive. I've been using Bitcoin as a diversifier. They're basically, there are pockets of value around the world, and every couple quarters, generally, you have one of these kind of open up. Either you have a correction or some sort of cyclical event happens, and it basically allows kind of an accumulation event to happen until that becomes more consensus, and then you kind of look for kind of what else got cheap. As Bitcoin's inflation rate keeps going down, in other words, its flow to stock ratio keeps decreasing, or stock to flow ratio keeps increasing, that does eventually, basically make it a harder and harder form of money. And it makes it so that anyone who wants to buy into the network, instead of buying into new coins, they have to be able to get existing coins from someone else because there's not that many new coins being generated. And so that can, push the price up until Bitcoin eventually reaches whatever steady state it's going to reach. Whenever it kind of reaches its the closer end of its total addressable market capitalization. I think there are significant, there is a foundation for those concerns. And so overall, my base case would probably look more like, after the late 60s when we had very high equity valuations and we entered a more inflationary period, you had a really choppy sideways market. It basically had a ton of volatility, you had significant drawdowns, you had poor returns, you had very poor inflation adjusted returns. And so overall, I'm kind of looking at that as kind of the lower end case for how this likely goes, where I think that with, basically the way it's currently structured, I don't think you're going to have, like, say, a 1929 style crash, because that, in that environment, the dollar is pegged to gold. So basically what you're doing is you're pricing the S&P 500 or the Dow in gold, and that's going down significantly and staying down for a very long period of time. Whereas if you're pricing something in a denominator that itself is losing value, it's a little bit more fluid. It basically can soften some of those giant crashes. But overall, if you look at the S&P 500, by most metrics, we are either the most expensive we've been in terms of, say, the Buffett ratio, the market capitalization to GDP, whereas other metrics show that we're like the second most expensive we've ever been in terms of, say, the CAPE ratio. Basically, we're second to the dot-com bubble. And there's 5 to 10 indicators that you can look at, and most of them say number one or number two. And so that's obviously a really big challenge for the forward returns of stocks. Now, a complicating factor is the fact that bond yields are also super low. And so, for example, if you look at the dot-com bubble, the equity risk premium was very, very low, meaning that it was almost a no-brainer to buy treasuries instead that were yielding like 6% and had a positive real return compared to buying equities. The challenge in this environment is if you look at, say, the past century of data, stocks are still kind of in a place where they could do equal or better returns potentially over the next 10 years than 10-year treasuries. And so investors kind of have that challenge where, they're both bonds and stocks are very expensive in absolute terms. And because those are the major kind of liquid investment classes, a lot of people are kind of looking at those two and say, well, I'd still rather own a significant chunk of equities.